Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for using your podcast app of choice, probably Apple Podcasts or Spotify, to check in for another episode of Zen and the Art of Real Estate Investing. My guest is Andrew Reichert, the CEO and visionary of Birgo. Birgo, their mission is to improve lives through real estate. If you go on the Meet the Team, it says the team that helps you thrive. And this is a team that actually cares about their people. Our episode today is about using real estate as a vehicle to live and grow. And Andrew has quite the story. Let's get right to it. This is episode 198 of Zen and the Art of Real Estate Investing with my guest, Andrew Reichert. Andrew is the CEO and visionary of Birgo. Birgo is a fully integrated private equity real estate investment and management firm looking to improve the lives of their clients through real estate. Andrew, welcome to the show.
Thanks, Jonathan. Appreciate you having me on.
Yeah, no, I'm excited to talk to you specifically because you are big on mindset, and that's my thing. And I created this podcast for the mindful approach to real estate investing. So I want to start there. How did you develop the mindset to be successful in real estate?
Well, it's a great question. And to answer it, if you don't mind, I'd like to maybe just take you back a little bit to how I got involved in real estate.
That's exactly what I want.
Yeah, great. Well, first of all, let me just contrast what I think is maybe a good mindset to the mindset that I had.
Yeah. So
I got expelled from high school, grew up in a bit of kind of tumultuous times as a result of that. And, had the really good fortune of, after being expelled from high school, actually getting accepted to a college. And it gave me this opportunity to really turn things around. And so I started asking myself the question, like, what do I want to do with my life? And why am I here?
Yeah.
And some of those bigger questions. And so really one of the books that I read in college that changed my life was Rich Dad, Poor Dad. So one of the things I liked about that book is it is a book about the mindset. He talks
Absolutely.
about the poor dad mindset and the rich dad mindset, and he talks about real estate. And so that book really was the impetus for me getting involved in real estate investing and really starting to develop the mindset that has really been a lifelong journey, but starting to develop the mindset that I have today.
Yeah. What led you to that book? Did somebody give it to you, or did it just kind of like, happenstance get in there? Because it's not for someone, 18 to 20, it's not the first book that you pick up if you think mindset or maybe if you think real estate, but still.
Yeah. So somebody suggested it to me, which I'm really grateful for that suggestion.
Yeah.
And, that was, I used to go to the library and go to that section of books, and I used to just burn through them. Another one that was my favorite, I actually ended up getting it on audiobook, which at that time was like my iPod.
Yeah.
I had it downloaded on my iPod.
Yeah.
And The 7 Habits of Highly Effective People was another one that I would listen to over and over and over.
Yeah, but there must have been something in you at a youngish age, before, early 20s or 18ish to want to do that kind of self-help and self-analysis, because I think the people who don't get to the right mindset or haven't got there yet are usually missing that kind of self-analysis point. Like, do I really want to work on myself, or do I just want to look for an escape hatch to make this easier?
Yeah, well, there was definitely that inside me. And I would probably liken it to ambition if I had to name it. And it was always there. I mean, it's what got me expelled from high school. I was ambitious for all the wrong things. I wanted money and selling drugs and, doing kind of all the wrong stuff. And so it was really just reframing that and directing my energy in a different direction.
Yeah.
I always had that in me. I just was directing it in the wrong ways.
Yeah, I mean, honestly, even that type of bad choice on what to do is still partly entrepreneurship at that age. You're trying to build a business to make money. If there was another product that other people wanted as much, that probably would have been excellent also.
Right.
Am I right? It's just like that's something that is highly in demand at the time. But it seems like by getting expelled from high school, you didn't kind of wallow in it. You got yourself to college instead of, going the other way, which obviously could have been not great.
Yeah. And to your point, it was entrepreneurial. And I think I started to get that entrepreneurial itch in high school. I kind of joke around. Some people are out cutting grass and I was out selling grass. It's like, I took a different path, but
but at the time, both pretty solid businesses. One's just legal, one's not.
Exactly. You got it. And so I do think it started to develop that itch in me of it's like, oh, okay, I can create my own destiny. I can control my own circumstances. And I think that, that led me to some of what I do today.
Yeah. Did you ever go into like regular 9 to 5 or did you go right into real estate?
I did. So when I graduated from college, I kind of had 3 things going. I was doing a full-time job with a regional bank here in Pittsburgh called PNC. Great job, great bank, still really have very fond memories of my time there, even to this day. Then I bought my first duplex the year I graduated from college with no money, I had no cash, no credit, no experience, which I'll have to tell you that story.
We'll have to find out how you got it done because everyone's like, well, that sounds great.
Yeah. And then I also had this little financial aid consulting business. I was kind of doing 3 things at the same time and had a lot of irons in the fire trying to see, what I was going to do.
Well, that's interesting, though, because, given what happened during the pandemic, a lot of people now are kind of testing a few different irons now to see what will keep working, with real estate being one of them. But maybe they're not, far along enough to make that a full-time thing. So that kind of, I'm sure, resonates with a lot of people. How did you kind of start to get down to what the core thing that you wanted to do was going to be?
Oh, through a lot of trial and error, a lot of mistakes, honestly. So with that duplex I bought, again, no money, no credit. I ended up closing on a first mortgage and a second mortgage at the same time. So this was things that banks were doing before the great financial crisis of 08 and 09, and probably why we had the great financial crisis.
Definitely part of it.
So I walk away from closing with a check for $20,000. And so this is like the most money I've ever had in my life. And so I take that check and I go buy some property and I refinance that and buy some more. And so I ended up getting to the point where I had 20 units. And so with those 20 units, doing the property management, the maintenance, the leasing, and then I start wanting to expand. So now I'm flipping houses. I'm doing new construction. Third party managing some commercial property, managing my own portfolio. I was doing a little bit of everything.
Yeah.
And as we scaled, I just knew something had to give. We started launching we launched our first fund in 2015, raised $17 million, bought 800 units of multifamily and about 250,000 square feet of commercial. So now we have multifamily, we have retail, and we have office. And it was through that process that we finally zeroed in on, hey, we're just going to be a multifamily operator, just a very certain asset size, and just do what we think we could be best in the world at and kind of cut everything else.
Yeah, but I'm sure it was important to do those other things to boil it down to, hey, like, let's just stick with this, buy box, investment box. So what did that turn into? Like, what's the size of the box now in terms of units for multifamily that you guys want to stick to?
Yeah. And to your point, we wouldn't have known how narrow we wanted to be unless we tried those other things. So, in some ways we had to take our lumps, on those other things to zero in on our buy box. But today we like properties around 100 to 150 units is kind of our sweet spot. Multifamily, Class B, workforce housing, average rent across our portfolios, $800 a month.
Yeah.
We like Rust Belt cities, Midwest, heartland cities like Pittsburgh, Cincinnati, Buffalo.
Yeah.
And that's what we do. We buy stabilized stuff that's already rented out. We add a little bit of value. we add professional property management and we kind of keep it going.
Yeah, I mean, when you're buying that kind of B class workforce, it usually is more operational where you're going to get because you probably want to buy things, unless you want to do a big value add, but it sounds like a lot of those, type of 100 units that get purchased are just not, they're being run into the ground or someone can't do it. Is that where you're finding it, or do you like to do more value add, or just does it depend on the asset that's out there?
We do both. It depends on the asset. It depends on the fund. So, right now we're recording this in, year 2024, and this has been the year of a little bit heavier value add. So our fourth fund, which we just recently launched, is an opportunistic fund because we're seeing opportunistic deals, heavier value add.
Yeah.
But, back in 2015, 2016, it was all about buying cash flowing properties. They'd cash flow from day one, and they'd be income producing properties with maybe a little bit less upside potential. So it really depends on the market, depends on the asset.
Yeah, but you made a good point. Those are different avatars of who's getting in on the deal with you guys. If it's going to be value add, they're going to have to wait a little bit for their money. So that has to be a more patient investor who understands how it works. That's why it's harder for new people to syndications to understand, like, hey, got to wait a little because those cash flow ones are great. You get in and the money starts coming. Have you found that those can sometimes be the same avatar, but you really have to be sure because you don't want to put someone who's expecting cash earlier into one of those wait and see funds?
Yeah, it definitely can be a different avatar. So today we have about 200 investors across our four funds. And we found that, about half of them are more income focused and the other half are more total return focused. And so, some of them like our older products, some of them like our newer products. And so not everybody re-ups and we have to go out and get new investors. But that's part of the business.
Yeah, but haven't you found, as someone who's at the head of the syndication front, sometimes the people who are in that first cash flow one, that's going so well for them, they're like, oh, well, I don't really need the cash flow from a second one. Maybe I want to try a value add, because you've built that trust relationship with them, which is so important when you're building funds.
Absolutely, yeah. And sometimes it's actually more about the trust and them investing in us than it even is the profile of the investment or the investment thesis. That's definitely true. Yeah,
I agree completely. I only started investing in syndications after 30 more years in real estate last year, and I found that operator always first. Like, the asset's important to me, but like as you said, there's a lot of other things surrounding the asset. If you trust everything around the asset, you're going to do the due diligence on the asset, but you're not going to have to do a deep dive. It's all right there because you trust everything else.
Yeah, I think you're betting on the jockey just as much as you're betting on the horse.
Yeah, I agree. And you can look at the data on the horse, but the jockey, you need to go one to one. Like, do I really like this person? What's their track record? How have they done so far? And I think that's really important. And how was it when you first started with the first fund? Because the first one's always the hardest because you don't really have a track record, but you did have clients that you had worked with already. So was it easier for you to kind of say, hey, now we're building a fund? People were probably asking like, hey, can we get in on some of your deals?
Yeah, for sure. So we took a little bit of a non-typical approach where we started out of the gate with a fund.
Oh, okay.
Whereas most operators start with a syndication.
Yeah.
And then try to work their way to a fund. So 2015, we wanted to do a little proof of concept fund, try to raise 10 million. We ended up raising 17. We oversubscribed it. And that kind of, we were off to the races at that point. So that's how we got our start. Just last year, for our first time in the history of the organization, we started doing syndications. Some of our investors just really wanted to do a deal as opposed to a fund. And so we started doing syndications as a bit of another product in our tool belt kind of thing.
Yeah. So for the listeners, if they don't know, syndication and fund difference, syndication's a specific asset and a fund is putting it in, could go into multiple assets.
Yep, exactly.
Yeah. So for the investor, a fund's a little bit more diversified, not necessarily like an index fund of stock, but similar in that, as you can get multiple assets and feel like you're kind of diversified inside one investment. Whereas, the syndication, which I've been investing, is you're really investing in the asset, through the operator.
Yeah, for sure.
Yeah. Do you prefer either one, or is it nice to be able to do both now that you have the syndication going?
As an investor or as an asset manager?
Yeah, as the manager.
That's a good question. I mean, I think if I had to pick as a manager, we probably prefer the fund because it's fully discretionary capital.
Yeah.
So it gives us the discretion to go out and chase deals and not need to worry about raising the capital for the deal.
Right.
It's like, where do you have the capital? So it just gives us a little bit more flexibility. I think I'll answer the question as an investor too, because I invest in syndications and funds as well. I think it really depends on risk return profile, because in a fund, to your point, typically in one of our funds, you might have 15 to 25 assets. And so you just get this much more diverse pool. And some of those assets are going to be total home runs.
Yeah.
And some of them are going to be dogs, they're going to be single digit IRR. So it averages out to typically around mid-teens IRR for a fund. Whereas in a syndication, you might be able to get 20 or low 20s IRR, but there's just that risk of, could it go lower? And so as an asset manager, I do like having the menu. So we can say, hey, if you have a higher risk return appetite, go for the syndication. If you're looking for a little bit more of a conservative play, go for the fund.
Yeah. Yeah, it makes sense for from a management side to enjoy the fund because people are trusting you with the money on how to disperse it and put it into assets. And then, like you said, you can be a little bit more risky because you've loaded up the top with, well, these are rock solid returns. So now we can get a little risky. So you have the whole portfolio balanced out.
Yeah, you got it.
Yeah. Just in terms of when you started investing, did you like multifamily when you got into it? Because for some people, landlording kind of sucks because you went really quick to 20 units and we're managing them all. And I know you've, succeeded in management. Did you like it when you started?
That's a great question. I actually talk about this in a book that I have coming out in about a month. And I tell the story of when I first started to operate within the real estate that we kind of managed. So first I'll tell you the ending and then I'll just maybe tell you that story a little bit. So the ending is our mission today is improving lives through real estate. And so what I love about real estate is the impact that it has on people's lives. I think a lot about our residents and we're like providing a home to them.
Yeah.
And that's a really cool thing. And our investors getting to steward their capital and our employees getting to provide an income for them and getting to help them live into their purpose. And so, purpose is something I talk about a lot. In fact, the book that I have coming out, Priorities on Purpose, it's all about purpose. What we talk about in that book is doing the combination of your passion, your proficiency, and your purpose. And so when I first got into real estate, I felt like it was my purpose. And I developed a passion for that mission. So like the ability to give people a home, but I needed to develop a proficiency in the business. And that's what really took 20 years. But what I like about real estate is I'm passionate about certain aspects of it. So the leasing process, for example, because I love giving people a home.
Yeah.
I actually really loved doing that work.
Yeah.
Whereas if you contrast that to, replacing a thermocouple on a furnace, I'm watching YouTube videos and I'm like, I think I can do this, but I'm never going to be passionate about that.
Yeah. I'm not even passionate enough to try.
I know
I'll fail.
Exactly.
Yeah. But that is a really, I grew up with a dad who was a landlord and investor. So I was meeting tenants, from a very young age. So I kind of always had the forward thinking of like, hey, we are stewards, like they're caretakers of our homes. And I think that's a very, very smart way to look at it, just as you're presenting it, that the money is a stewardship for these tenants. But I think it's weird, I think sometimes that the outside perception of real estate investors is like we're all just like money grubbing as landlords. And that's just weird to me because I grew up like knowing tenants. And I think there's all of my friends are all very good landlords who care about their tenants. They want to make sure they get in a good tenant, but also like, as you're saying, part of being able to own real estate is you have the opportunity to give someone a leg up. If you're the one judging it and you're experienced in property management, you can look back and say, oh, well, they had an eviction 6 years ago. Wow, they've really, done it since then. No one else is going to rent to them. I'm going to give them a chance. Like I can give them a chance. Have you found that gratifying just on the, that set that you were talking about before?
Absolutely. And that's exactly how we think of our mission. Like that story you just told we call those improving lives through real estate stories. Yeah. And we see that all the time. I mean, we see the story where it just literally yesterday, one of our teammates shared a story where the wife had stage 4 cancer and wanted to live out her final days in a ground floor unit. And so we moved them into our unit so that she could have her last few days on this earth.
Man, amazing.
In a peaceful place. Yeah. And then after she passed, we helped the husband to find another unit at that property that was good for him. So like they just gave us this really heartwarming story of how we've improved their life through what we do. So that is what I think of when I think of our work.
Yeah. And I find that to be a little bit unseen because it's just like, investing. I mean, the news, of course, isn't representative of what really happens. It's like, a hybridized version of, whichever extreme you like. But for so many years, people have just been kind of chugging along as landlords, helping people out, providing housing. And if we are truly in an affordable housing crisis, the more units and better management, the better that people can succeed. Maybe they can't buy a home at the same age that we did, but maybe they can get really nice rentals at good prices that are very well maintained and managed, which I think is one of the biggest problems just in overall multifamily, from a tenant's point of view. If you have bad management, you're not going to enjoy living there. Then you're not going to take care of the place. And it becomes a slippery slope where both sides are just going in the tank.
Yeah, you got it. And so I think profit is actually a good thing for the real estate operator because it allows
improvements.
It allows for improvements. The last thing you want, and I've seen it happen over and over, is the property's not profitable. So it becomes I hate to use the term, but like a slumlord kind of situation, and they're just not taking care of the property. And so profit actually allows operators to take good care of tenants.
Yeah, I had a tenant once say to us, they were like very far behind, 3, 4, 5, 6 months. He lost his job. They'd been tenants for 15 years, so we were letting them slide. And she said, "Well, you own other properties, so can't you just take the money and move it?" I was like, "No, like that's not how it works. Your rent is what pays for the improvements. So it's not like I'm going to not repair your heat if it breaks, but then we have to take it from somewhere else and then pay it back." So right. They have to also think like, hey, we're running a business. We really want to take care of it. And that's why I've always found like, I personally don't enjoy being a landlord, but I like being able to provide housing. I just don't like the interface because I'm an introvert and I don't, I just don't want to have those conversations as much as I don't want to try to fix that furnace.
Yeah, exactly. Yeah. I mean, you and I are wired a little bit different. And so like the stuff that I like doing in the business, like the leasing, you probably wouldn't like doing. And then I need somebody like you, in the operations of the business.
Yeah. Was that important to you though, when you were building out Birgo? Because I was on the site and you have a huge staff and it just looks like, part of building a business, especially in real estate, is getting all the different types of personalities. So, like, hey, I'm really good at this subset, but that I don't like at all. So I need to bring in an expert who's good at that, because that's what will help you scale as a business, especially in real estate.
Yeah, absolutely. We actually really view diversity as a competitive advantage. Yeah. And I mean that in a broad sense of diverse thinking, diverse personalities, diverse strengths and weaknesses. And then obviously the traditional sense as well in terms of diverse, gender, race, things like that. But I've always viewed that as a need for us as a business. And we think about that a lot. We don't hire anybody without them having done our personality assessment just to see where they land and how they're going to fit on the team and what unique gifting and skill set they're going to bring.
Yeah. I mean, anybody who's into operational systems, which it seems like did you create the Rhino system? Is that your system?
Yeah.
So anyone who's interested in those systems knows about putting people in the right seats. So this is so important. So for people who are newer to investing, but see later they want to get into syndications or building a property management, these things can really be helpful. I found it even when I was building small companies, those personality tests can really tell me what I need to know later. Because a lot of times you're like, that's the wrong seat. I should have listened. And as you've grown, it's obviously helped you kind of create organizational continuity across. That's what it looked like. At least I got that vibe from the site, which is actually hard to do, but I really did.
Yeah, thank you. And
yeah, sure.
That's a function of us making a lot of mistakes through the years. We didn't always get it right, and we still don't always get it right. But yeah, we've grown from 0 employees to 100 employees, over that past decade. And I think you learn a few things about people and how they're wired and what's going to be a good fit for us as an organization.
Hey, it's Jonathan. I hope you're enjoying this episode with Andrew Reichert. He has quite the story, and we go all the way through it to the end, so keep going to the end of the episode. On this brief interlude, I want to talk to you about a company that I am now an ambassador for. They're called GeoShip, and it's about living outside the box. It's a regenerative housing solution. Now, these are bioceramic geodesic homes. If you know about geodesic domes, they started with Buckminster Fuller. I've been obsessed with them for a really long time. Now, the future of home with GeoShip: slash your cost of living, optimize your health, reconnect with the earth, and create the future you imagine. This is a company that I've been invested in since the beginning, and I'm still going as the ambassador, building the regenerative future. I can't wait until these are launched. They are in another funding round. You can always reach out to me for any information, and I'll get you in touch with whoever you need to. Let's get back to Andrew. Your headquarters is in Pittsburgh?
Yeah, it is.
Yeah. And so, let's talk geographical, like where you're buying. You said Rust Belt, Sun Belt. But what geographical markers are you looking for when you're looking to make an acquisition? We talked about the number. You said 100 to 150-ish range is good. But what about some of the other things that you're looking for in terms of cities, growth?
Yeah. And so we have like a 12-point checklist that we run markets through. And there's not a ton of markets that actually make it through that checklist, interestingly enough. Yeah. So the easiest way that I can describe it is markets that are like Pittsburgh.
Yeah.
And so what I really love about Pittsburgh is it's undergirded by a strong economy, strong economic drivers. We like the meds and the eds.
Yeah.
So when there's good medical and education facilities, we actually like when there's a good, strong sports team.
I think that's really important. It
helps to drive in, drive culture and people.
Yeah, I mean, if you luck out with a World Series or, a Super Bowl, you're all the short-term rental owners are crushing it.
Yeah, of course. Pittsburgh may never luck out with a World Series, but
yeah. Well, right. You almost have to luck out as the host. It doesn't really matter if you're the team anymore.
Right, exactly. Yeah. So yeah, it's interesting to look at those dynamics. I mean, then we're looking at cap rates. We're looking at, can we get the yield that we need? We look at just diverse economic drivers. So, here it's financial institutions and banking and, there's just all kinds of, there's manufacturing and just tons of diverse industries that fuel the economy. Technology is huge here now, with Google and Facebook all having major employment centers here. So we just look for markets like that.
Yeah, I like the way that you said that, though, because you pick a market that you start in, for you, Pittsburgh. But I think it's smart to say, well, that's our avatar. Let's look for other cities like Pittsburgh because we know how to work Pittsburgh. Yeah. Maybe it's not going to be the same officials and everything, but we understand this kind of workforce housing. What B means in Pittsburgh isn't really B in Philadelphia. These are different beasts. So I think that's really important because I have found that I think people who move too quickly, they find a deal. You may have a lot of contacts and someone says hey, do you want 80 units in Omaha? You don't know anything. It takes a long time to really learn Omaha. So how much do you do kind of out in the field saying hey, how much really is it like Pittsburgh? Do you send somebody there as a team go? Or are you just matching kind of the financial data versus the population growth? And like you said, eds and meds and what's in the area.
Yeah, exactly. Yeah. So I think it's kind of a broad, you got to look at all of it. We put weighting on each of those things in the 12-point checklist and then we kind of run those other markets through that filter and, just try to make a good investment decision. There's only so much you can do to analyze the market, analyze the asset, and then we try to make good decisions from there.
Yeah. And the 100 to 150, what's that based on? A lot of people have put a number, for me, guests on the show, around, whether you need on-site management or not. And that's really where their number moves. What's the number for you? Why is it 100 to 150?
Yeah, I mean, it certainly gets easier if you can have an on-site manager and a full-time maintenance person on site.
But it has to be cost-effective too. Yeah, that's why you can't do that at 20 units. It doesn't make sense.
For sure. So that's certainly a consideration. But for us, it's also just acquisition. So we'd like to be above the mom and pop investor, but below the institutional investor.
Yeah.
So that's kind of where we found that sweet spot in our markets.
Yeah, I think institutional in my head, I think like 250. Am I right? Am I right on that?
Yeah, exactly.
Yeah. And then mom and pop is like, I don't know, 20 to 50 usually, because 50 is a lot for a mom and pop.
Right.
Like they're great to buy from, but maybe not for you, but like for someone who's like kind of a mid-range before they become big, that those 40 units are great because those people are just you can't manage 40 units, when you're 70 years old. It's just not fun.
Totally. Exactly.
Yeah. So were you doing property management all along? And was that an important tenet to keep kind of within the organization of what you guys do?
Yeah, we have always been vertically integrated. We've always been an owner operator where we do the operations as well. And yeah, that was how I started. I bought some units, managed them ourselves. And because of that, we built the systems out to do the accounting, bookkeeping, accounting, property management. We got the property management system in place, in-house maintenance, all that. And so that's just kind of how we started and we kept it going.
Yeah. Being able to build that out obviously must have had something to do with how you built the systems that you built also, because to run vertical integration and property management inside with all of the other things, the property management is very hard to do for anyone who doesn't know. Like if you don't have like a very tight system that you're always tweaking, and making better, you're going to have unhappy clients on that. And am I right on property management? It's a tough business.
It's a tough business. For us, it's a zero margin business. Yeah. So it's not something that we do as a profit center. The reason that we do it is because our mission is to improve lives through real estate. And we think that it gives us the best ability to impact people's lives by being in close proximity to them. And then as an investor and as an asset manager, I also think it provides a differentiation where we can say, okay, we're thinking like an investor at the property management level. Yeah. So does the furnace really need to be replaced, or can we swap out the fan and get another year or two out of it? Right. We're always thinking that way. And I think that just helps us out as well.
Yeah, as someone who's been involved in property management for so long, I wanted to get your take on this because I talk about it a lot. When there's people who are, maybe they live in California or something, and they just want to get like one unit in the Midwest because it's great price, good way to start. But I've always said like, that's not really that attractive to a property management company to just have a one-off. You're going to be like the lowest on the totem pole. Not that they're saying like, oh, you're less valuable, but someone who has, 70 units is more valuable as a client than one house in the Midwest. It just ends up in my mind being like that. Am I right? Not that they would treat them differently, but not as high a priority a client.
Yeah, I think that's 100% true. There's a different level of ownership, a different level of buy-in that I think we really want to make sure that we're pushing into our organization.
Yeah, and I would see it as like the bigger, better property management companies. They're not going to take that one off. So the one off is going to like very new property management companies. So a lot of people with one offs, like they'll get management, they're paying whatever 12, 16%, and they're like, it's terrible. I was like, it's terrible because you only have one unit, and they've only have 6 units. They're just, you don't have a system like we were saying.
Yep, exactly. Yeah. So it's kind of a lose-lose when you're in that, in that size. It just, it makes it really hard to kind of have good service for that demographic.
Yeah, but don't you think now with all of the technology that for the people who are like have 1 or 2 units, all of my landlords that I work with, they all self-manage. I teach them how to self-manage until they get up to a level where it doesn't make sense or that it's cost effective to do. I think it's pretty easy to self-manage just like one unit now, just one or a couple.
For sure. I think it's a question of, what else do they have going on? Do they have the bandwidth to do it? For me, like right now, I got my wife and we're raising 3 kids and I'm traveling. Like there is no way I could self-manage a unit in addition to my job. And so I think there's a season of life for that, particularly as you first start out. And the reason I really like that you also encourage that is I think it teaches you the business. Yeah. It's easier to manage a third-party manager when you've done it.
Yeah, absolutely.
You know what to expect and you know what's you know how difficult it is, like you said.
Yeah, that's it. Exactly. How can you manage the manager if you've never even managed one property? That's how you get
Yeah.
skimmed, or you just don't know, or they're doing more service calls and you're like, well, that's a lot of furnace calls. Like it should have already
Right.
been fixed, once. But I do think that's important because there's people who don't have the time, like you said, you have kids, jobs, other things to do, but still you have to have some connection to that real estate or eventually it's going to get away from you.
Yeah.
If you're new and you're only trusting other people to management and you don't even know what they're doing, that just seems like you're going to be losing money along the way.
Yeah, totally.
Yeah. So what was it when you kind of went into commercial and retail? Why wasn't that a fit for what you guys like to do?
Yeah, it's a good question. I think there's a couple reasons. I mean, again, one, if I just go back to our mission, improving lives through real estate, like I think most of the time when you're in commercial, you're working with a business.
Yeah.
And there's a lot of opportunity to improve businesses through real estate as well. But it was less missional for us. Yeah. Like it's just less connected to our mission. So I would say that was one reason.
It's not the same feeling handing over the keys to like a brand new condo unit, someone's first place that they've ever got, and to someone who's just moving their chiropractic practice 2 blocks.
You got it. Yeah. I mean, you're watching them raise their kids, you know, in the house that you're providing for them versus, like you said, the chiropractic practice or whatever it might be. So that was part of it. I think too, the skill set is just different for commercial property management than residential. And we're technically set up to do both today, which is fine. Like our property management system does both fine, but there's just a little bit of a different risk return profile. There's a little bit of a different investment profile that I think it just made more sense to pick a path.
Yeah.
So
it makes sense though, because you guys are really focused on mission. So mission drives that. And like you said, it's just not the same feel, again, with a bunch of businesses. They're nice, but it's just a different vibe.
Yeah, definitely.
Yeah. And I think that's important though, for investors who are coming to you to invest in your funds or a syndication to know like, hey, we tried out some other stuff, but we're locked in, like multifamily is our thing. And across all my guests, a lot of people are just like, hey, we're multifamily. Like we're good at this. We're vertically integrated. We know the area. We know what we're looking for. We've tried self-storage, but again, just not the same thing.
Yeah, exactly. And I think that's wise. I think you got to pick a path, know what you can do. And there's a million ways to make money in real estate. I always say, there's a zillion things you could do, but pick what you should do.
But as an investor on your own, do you ever invest in different type of things? I have talked to a lot of heads of syndications or people who run the office, and they're like, yeah, I don't like self-storage, but I'll invest with somebody else because I know them and they're a great self-storage syndicator. So I want to get a piece of self-storage. I don't want to do anything. I don't want to be the manager. I want to be the LP.
Yep, 100%. That exact example is true for me. Yeah. I am in 2 self-storage funds and I love it. Great return profile. Yeah. It's done really well for me. And again, like I trust them to do what they do best and I focus on multifamily. It's actually a great synergistic relationship.
Yeah. And I found that a lot of operators do that bounce back and forth between each other, a group of 3 or 4, like all know each other, but do different asset classes. It's very easy to build those relationships and just like, oh, well, I'll dunk some in here and you'll put some in here. And then you really have a good way of referring people back and forth to vetted operators in the field.
Yeah, absolutely. That's exactly how I think of it.
Yeah. I mean, that's why, I never invested in multifamily as an investor. I was basically single family, did some commercial, industrial, but now being able to be in this many units in multifamily and in different towns that, cities that I would never be in, that's exciting for me. And that's where I think that the profile, there's some investors who maybe are thinking in the beginning they want to flip, which to me is just crazy to start off doing that. I'm starting to say that I think, syndications and funds could be great stops for those people who are too busy to do it early as a first investment, because you can learn a little along the way, not as hands-on, but also get a good return that's very steady and a little bit more stable than going to try, flip a $200,000 house on weekends.
I totally agree. I mean, that's a bit of a soapbox thing for me, because I just think that folks too often, get involved in things that they're trying to develop the skill set, as opposed to there's a Dan Sullivan book that's called Who Not How.
Yeah, we talk about it all the time. It's the best.
So like find your who,
yeah.
and just work with that who. And so I think that that's the right approach. And I definitely think as it relates to investing in other syndications and other products, there's just a lot of opportunity out there. And so I have an abundance mindset.
Yeah.
And I think a lot of operators, unfortunately, have a bit of a scarcity mindset. And so even with our investors, I will refer them to other fund managers and syndicators. And I'll even say, hey, look, if you want other multifamily folks, here's a couple.
Yeah.
Here's a self-storage fund I'm in. Here's a mobile home park fund I'm in. Like, I just have totally open hands as it relates to referring people to other operators, because I just think that that's the right approach.
Yeah, I completely agree. I also think it's a great way for people to know that you're not on the hard sell. You're not always on pitch mode or something like that, because there is a lot of shiny objects out there that make it much harder for someone new to understand. Like, I don't know. I mean, that looks pretty good. I mean, everything looks cool on TikTok. And then you realize, but it's not really a real thing.
Yeah,
So for somebody who say, yeah, I don't think we're a good fit, I think that builds trust. Or to say like, hey, this might be a good fit, but I also have a couple of friends who do this. So like, wow, that is a real trust building. And like you said, complete abundance mindset, which I think shapes again, and it goes with your mission as well.
You got it.
Yeah. So if someone were, brand new in this economic environment, there's high interest rates still. None of us think they're ever going back to these, threes or something like that. How would you tell someone new to the game who has some money to burn, what should they do with it now? We were just talking about potential syndications. What do you think a great option is for someone who's, ready to get started now and has a little bit of money to do it?
It's a good question. I think it depends on what a little bit of money is.
Yeah.
And it depends on the risk return profile, the risk appetite, I would say,
right,
of that particular investor.
Let's say like, $50K. So they have enough to get into a syndication if they wanted to, if they were overall, net worth accredited, or they could, of course, knock out a house hack or something like that. I mean, it is very, based on someone's risk profile. But with rates high, it's like, this is where I'm always kind of going now with new investors. Like, I'm seeing things a lot differently than I used to.
Yeah. So it's a great question. I'm obviously a bit biased. So if I can just share my very biased perspective.
Well, it's what I've been thinking. That's why I like talking to people about it. Yeah.
Yeah. Take it with a grain of salt. So I've had many friends come up to me and say, hey, like, I'm thinking about flipping this house. What do you think? Blah, blah, blah. And I'm usually pretty honest with them and just say, hey, look, you can do that, but you're going to make maybe 50 grand and it's going to suck up so much of your time.
You're going to hate every second.
You're going to hate it. You're going to hate me.
Yeah.
You're going to hate your wife, know? So, I've become a strong believer in investing in other people's funds. And, we just had this conversation. I think it's very accessible now. Like our first fund, the minimum was $250K.
Oh, wow. Yeah.
And so we brought that down to $50K just to make it more accessible. So our fourth fund is an opportunistic fund, already has a huge pool of assets in it. And so, my very biased perspective, if somebody is like, hey, I got 50 grand, I just want to get involved in real estate, I'd be like, our fourth fund is open.
Yeah.
And that's not meant to sound like a solicitation. That's my biased, but also kind of honest perspective is like, it doesn't have to be our fund, but if there's a fund like that where we already have, I think we already got 16 assets in this fund, and you can put 50K and you get exposure to 16 multifamily assets that have already appreciated over the past 18 months.
Yeah.
It's just, I think it's kind of a no-brainer for the investor to get into.
Yeah. And I think it's like kind of soft fun, the assets, so you can look them up on Google. You can see, wow, well, actually that looks pretty cool. You get a little bit of a feel for it without being like overexposed. I really like syndications for first time investors now. The only thing that I'm matching with it is really house hacking, because it's just smart. You buy a 2-family, live on one side, that's never going to get old. It's a great idea.
Right.
It's just harder to cash flow now, but you can certainly, if you're in an appreciating market, you're going to do great. I don't really see anything that's as good as those two right now, just because of the risk profile. Like you said, house hacking, it's still a little bit risky, but you're also getting the enjoyment, out of it. So there's like that trade-off. But, I don't know if someone goes in trying to get hard money now, 14%, 3 points, don't know what they're doing, just not very rarely is it going to go well. It might not go terrible, if you buy right, but there's not a lot of inventory right now. So I feel like you're going to have to overpay for small assets, where in the large scale, you don't have to overpay for these assets that you're putting into the fund. People, you're able to get access to the deals that aren't available for like tiny investors who are just looking for, one house on the corner to do it. Those are getting, pushed up by, single family home buyers or trying to buy the same homes.
Yeah. And I think you nailed it. You hit on a key point, which is scale. And I think the issue is at the smaller level, like a 50K investment size, you're making a much bigger bet on a much smaller investment, and versus making a small bet in a big pool of capital. And I think that the scale really does matter.
Yeah, and PS for the listener, if you have 50K and you want to buy a multifamily, you don't have 50K, you have 35K because you need 15K for reserves. So you're already down. You don't need reserves when you're investing into a fund or a syndication because you're putting it in, it's all accounted for, and you're getting monthly updates. It's really been interesting because, again, like I said, I invested first time at 52 into a syndication. Growing up, I never even heard about them. My dad was just buying single family and random land and stuff like that. But as I get older, it's starting to make more sense. But I'm starting to think, and my kids are both adults now, and I look at it like, this actually seems pretty smart for them too, because we're looking at the way affordable houses is going, and they're not going to be able to, a lot of people aren't going to be able to go buy that first house, and they want to buy an investment property. But again, when you start to weigh these risks, some interesting options out there that I don't think kind of first time investors used to think about.
Yeah, totally. And I think that that's just wise to stay on top of what are the new options and to be innovative in your thinking and say, hey, we don't have to invest the way we've always have. There's new options that might provide a better, risk return profile.
Yeah. I mean, maybe it doesn't make as good of a, an Instagram story, but the bottom line is, boring real estate is what gets you paid long term. So
you got it. Ain't that the truth?
Awesome, man. Is the best place for people to get in touch with you and learn about Birgo at birgo.com, which is BIRGO.com?
Yeah, absolutely.
And they can find you through there too on the About?
Yep. You can go to About, find me there. So Birgo.com is our business. Or if you're looking for me personally, I'm pretty active on LinkedIn. You can always check me out on LinkedIn as well. Yeah.
And if you guys go to Birgo, I thought one of the coolest things about your site, I was on the About portion. And when you hover over each person on the About, it kind of, everyone makes a funny face. I just thought that was really cool. It made me like, it's much more accessible. And I think that now talking to you for an hour suits the mission, makes it much more like fun to do business that way. So I really appreciated that. I hope people go and check that out.
Yeah, it's very, very ingrained in our culture. It's honestly just ingrained in me personally and my family. Our family's core values, the first core value is play.
Yeah, that's awesome.
Just life's too short to take everything too serious.
Yeah.
Getting back to mindset, and I actually, on a more sobering note, I got diagnosed with cancer 10 years ago. Yeah. This year is actually my 10-year anniversary from that. Wow, and awesome. That was just, that was just a wake-up call for me. In fact, for those watching the video, I have this mustache because it's Movember, which is a men's health initiative. And it was just a wake-up call for me that hey, life is short. None of us are getting out of here alive. Let's make the most of every moment. And so that's why our team photos have this silly face thing. Yeah. We're trying to have some fun while we're doing this thing. We don't want to take ourselves or the business too serious.
Yeah. And everybody, real estate is fun. As you were saying before, you can be a part of providing housing for other people. You can also enjoy it. Everything doesn't have to be a grind just because it's your job. You don't have to seek retirement to have fun. I don't want to retire. I like working. I just want to have fun when I'm working.
You got it. Isn't that the truth?
Yeah. Awesome, man. Well, I really appreciate you spending the time. I definitely look forward to staying in touch with you.
Thanks, Jonathan. Appreciate it. Thanks for having me on.
Absolutely. That was Andrew Reichert, the CEO and visionary of Birgo. You can find them at birgo.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get that preview of the guest for the next episode of Zen and the Art of Real Estate Investing. And next episode is 199, so we're getting really close to 200. My guest is Ray Glimpf, a real estate investor and mentor who went all the way from the bottom to what I would say is the top now, but he's going a long way farther than this. Over 100 doors, and he is really in the trenches. So if you want to talk about buying properties off market, being a local home buyer, this show is for you. And you're going to learn a lot either way because Ray has done it all himself. See you next episode with Ray Glimpf.